Welcome to this guide on understanding the volume indicator in the stock market. Today, we are going to dive deep into what the volume indicator is, why it matters, and how you can use it to improve your trading decisions. By the time we are done, you will have a strong understanding of how volume can help you read market trends and make more informed trades. Ready to get started? Let us jump right in. First, let me ask you a question. Have you ever wondered how you can really tell if a price move in the stock market is genuine or just a fleeting moment? This is where understanding the volume indicator can be a game changer. Think of the volume indicator as a tool that shows you how many shares or contracts are being traded at any given time. It is like taking a pulse check on the market. The volume indicator helps you gauge how much buying and selling activity is happening during a specific period, and this insight can make a huge difference in your trading decisions. So why should you care about volume? The answer is simple. Volume tells you whether a price move is strong or weak, and that knowledge can be the difference between a successful trade and a losing one. Additionally, volume can be used to identify various chart patterns that provide deeper insights into market behavior. Patterns like double tops, double bottoms, head and shoulders, ascending triangles, descending triangles, and wedges can all be confirmed by analyzing the volume levels. Let us dive in and uncover how these patterns interact with volume and how they can help you make smarter trading decisions. Let us break down a few of these patterns more thoroughly. During a double top pattern, the price hits a resistance level twice but fails to break through. The second peak is often marked by lower volume, signaling that the buying interest is fading and a potential reversal is likely. In a double bottom pattern, the price hits a support level twice, and a spike in volume during the second rise suggests strong buying interest, confirming a potential reversal to the upside. The head and shoulders pattern is another important chart formation. In this pattern, the price forms three peaks, with the middle one being the highest. Typically, volume is highest during the first peak, and it decreases during the formation of the head and the second shoulder. This decreasing volume suggests weakening buying momentum and indicates a possible reversal to the downside. Conversely, the inverse head and shoulders pattern is a bullish reversal pattern where volume often increases significantly on the breakout above the neckline, signaling strong buying pressure. Ascending triangles are continuation patterns where the price forms higher lows while facing a horizontal resistance. The volume tends to decrease as the pattern forms, and then spike during the breakout, confirming the upward move. Descending triangles, on the other hand, show lower highs and a horizontal support level. Volume decreases during the pattern formation, but rises during the breakdown, confirming the downward move. Wedge patterns can be either continuation or reversal patterns. Let us take a closer look at each type of wedge. In a rising wedge, the price makes higher highs and higher lows, but the range between these highs and lows is gradually narrowing. This tightening range shows that the upward momentum is losing steam. Volume generally decreases throughout the pattern, which further indicates that buyers are starting to lose interest. This makes a breakdown to the downside more likely. When the price finally breaks below the support line of the wedge, an increase in volume often confirms that sellers are taking control and that the breakdown is genuine. Rising wedges are often seen as bearish signals because they indicate exhaustion in the current uptrend. In a falling wedge, the price makes lower highs and lower lows, but the range is also narrowing. This type of wedge can often signal a potential bullish reversal as the downward momentum begins to weaken. Throughout the pattern, volume usually decreases, showing that sellers are losing their grip on the market. A breakout above the resistance line of the falling wedge with increasing volume is a strong confirmation that buyers are stepping in and a reversal is underway. Falling wedges are considered bullish patterns, and when confirmed with rising volume during the breakout, they provide traders with a good opportunity to enter long positions. Both of these wedge patterns can appear during trends, either as a continuation or a reversal signal. It is important to pay attention to the volume, as it provides vital clues about the strength of the move. Without volume confirmation, a breakout or breakdown from a wedge could be false, leading to a failed trade. By understanding how volume interacts with these patterns, you can better determine whether the breakout or breakdown is likely to succeed and adjust your trading strategy accordingly. Recognizing these patterns with volume helps you make smarter decisions, as it provides an extra layer of confirmation beyond price alone. Let us explore a few more common chart patterns and how volume plays a crucial role in them. Imagine this for a moment. If you see a price going up, but not many people are trading, it might mean that the price move is not solid. On the other hand, if you see the price rising and the volume is also increasing, then more traders are jumping in. This means the price is backed by real strength. Let us make sure you are ready to spot these moments. Let us break down how to read the volume indicator in a way that is simple and easy. Picture a situation where the price is going up and you see more volume with it. This is usually a strong signal. Buyers are interested and more people are putting their money behind the move. This means the trend is likely to continue in that direction. Now think about the opposite. If the price is going down and the volume is also high, this tells you that many people are actively selling. It gives the downtrend strength, and you know it might continue. High volume generally means there is more commitment, whether the price is going up or down. Now, let us add some more detail by looking at specific chart patterns and their relationship with volume. For example, in a *** bull flag pattern ***, the price moves up strongly, then consolidates with lower volume in a channel or a tight range that slightly drifts down or sideways. When the price breaks out of this consolidation range with a sharp increase in volume, it indicates a continuation of the uptrend. The increased volume signals that buyers are stepping back in after a period of rest, and the trend is likely to resume. Similarly, in a ** bear flag pattern **, the price drops significantly and then consolidates upwards or sideways in a tight range with decreasing volume. When the price breaks down from this consolidation with increasing volume, it indicates a continuation of the downtrend. The increased selling pressure is confirmed by the high volume, suggesting that sellers are firmly in control. Another common pattern is the ** cup and handle **. In this pattern, the price forms a rounded bottom, creating the cup shape, and then consolidates in a smaller downward drift, forming the handle. Volume is generally higher on the left side of the cup, decreases as the price rounds out the bottom, and then increases during the handle formation. When the price breaks out above the resistance level of the handle, you want to see a surge in volume. This confirms that buyers are back in control, and the breakout is likely to be genuine. In the case of ** triangles, ** like symmetrical triangles, volume often decreases as the pattern progresses. This indicates a lack of conviction on both sides. However, when the price finally breaks out of the triangle, either up or down volume should increase significantly. This confirms the breakout direction and adds weight to the move, helping you determine whether to enter a trade. If volume does not increase during the breakout, it could be a false signal and you should be cautious. The asterisk rectangle pattern is another pattern to watch. In this scenario, the price moves between a horizontal support and resistance level, forming a box-like range. Volume often decreases during the consolidation phase, indicating uncertainty among traders. When the price breaks out of this range with increased volume, it signals that a clear direction has been chosen and confirms the validity of the breakout. By thoroughly understanding these patterns and how volume interacts with them, you will gain a deeper insight into market psychology and price movements. Volume provides an essential layer of confirmation, ensuring that price movements are backed by real interest from market participants. Without this, patterns alone can be deceptive and may lead to false signals. What about when the volume is low? This is important too. When there is low volume, it usually means not many traders are interested at that time. You might see the price moving, but if fewer people are involved, the move might not be trustworthy. Low volume can lead to choppy market action where the price is unpredictable and lacks any real push. In such situations, price movements may be easily influenced by a few large trades, making the trend unreliable. If you see a price rising or falling but with very little volume, that is often a reason to be cautious. It might mean the movement does not have enough support from other traders. In addition, low volume is often seen during consolidation phases, when traders are waiting for a clearer direction before committing. Watching volume closely during these periods can help you determine if a breakout is imminent or if the market will continue to move sideways. Now let us talk about something exciting: volume spikes. A volume spike happens when there is a sudden increase in trading activity. Imagine a graph with a sudden tall bar in the volume section. That is a spike. These spikes are really powerful because they usually mean something significant is happening in the market. If the price breaks through a resistance level and you see a volume spike, it means that many buyers are getting in at the same time. This makes the breakout much more likely to continue. The same goes for a support level. If the price nears a key support and there is a volume spike, it might mean a reversal is coming. The idea is to keep an eye on these sudden changes in activity because they can tell you if a big move is around the corner. Another key way to use volume is to confirm trends. Imagine you see an uptrend on a price chart. Now look at the volume. If volume keeps increasing along with the price, it is a sign that buyers are in control. The trend is solid and it might continue. On the other side, if a downtrend is in progress and the volume is going up, sellers are in charge. But what happens if volume starts to drop while a trend is still going? If the volume starts falling, it might mean the trend is losing strength. This could be a sign that a change is coming, either a reversal or a period of sideways movement. It is important to watch for these clues. They tell you when a trend might be running out of steam. Let us shift our attention to breakouts and how volume can help you. When a price breaks out of a key level, maybe it pushes above resistance or falls below support, how do you know if the move is for real? The answer is to look at the volume. If you see volume rising during the breakout, then it is more likely that the price move will hold. It means more traders are getting involved, adding strength to the movement. If the breakout happens but volume is low, it is wise to be cautious. It might be what traders call a false breakout, where the price moves beyond a key level but then quickly falls back. The next time you see a breakout, make sure to check if the volume is confirming it. Volume can also help you spot possible reversals. Imagine the price of a stock is rising, and then it hits a major resistance level. If you suddenly see a volume spike at that resistance, it might be a signal that sellers are stepping in. This is often a sign that the uptrend is losing steam and the price could reverse direction. When price action approaches a key resistance level, high volume indicates that the level is attracting a lot of interest, and if selling pressure outweighs buying, it could lead to a significant reversal. It is the same story with support. If a price is dropping and there is a big volume spike near support, buyers might be getting ready to take control. This volume surge at a support level suggests that the price may not go lower, as increased buying pressure absorbs the selling. When a reversal happens at support with high volume, it adds weight to the move, indicating that buyers are confident and taking control. Another concept that is important here is divergence, which occurs when the price action and volume do not align. There are two types of divergence: bullish divergence, and bearish divergence, Bullish divergence happens when the price is making lower lows, but the volume or an indicator like on balance volume is making higher lows. This can indicate that selling pressure is decreasing and buyers may soon take control, potentially leading to a price reversal to the upside. On the other hand, bearish divergence happens when the price is making higher highs, but the volume is decreasing or indicators are making lower highs. This suggests that buying pressure is fading and a reversal to the downside could be on the horizon. Volume divergence can be a powerful tool to identify shifts in momentum. For example, if the price keeps rising but the volume starts to fall, it shows that fewer participants are willing to buy at higher prices, and this often leads to a reversal. Conversely, if the price falls but volume rises, it can mean that strong selling is coming in, which could accelerate the downtrend or, at times, signal capitulation before a reversal. Being aware of volume behavior near key levels and identifying divergence can help you spot potential changes in trend direction before they fully develop. It tells you to be on alert for a potential change in direction and allows you to adjust your trading strategy accordingly. There are a few advanced volume indicators that can give you even more insights. Let us explore some of them in more detail. One is called on balance volume, OBV **. On balance volume adds or subtracts the day's volume based on whether the price moves up or down. This means that if the price closes higher than the previous day, the entire volume is added to OBV, and if it closes lower, the volume is subtracted. It helps you see if big players are quietly buying or selling before the price actually changes direction. For example, if OBV is rising while the price is staying the same or even falling, it could indicate that smart money is accumulating shares, getting ready for a potential upward price movement. Another useful indicator is called the **volume oscillator **. This one compares short-term volume with long-term volume by taking the difference between two moving averages of volume, typically a shorter moving average like 5 days and a longer one like 10 days. When the short-term volume exceeds the long-term volume, the oscillator moves into positive territory, signaling that market momentum is increasing. Conversely, if the short-term volume falls below the long-term volume, it indicates a decrease in market momentum. The volume oscillator can be especially helpful in identifying early signs of a shift in trend strength, either an increase or decrease. ** accumulation distribution line ADL ** is another powerful volume-based indicator. This indicator combines both price and volume to show you whether there is more buying or selling pressure in the market. Unlike OBV, which only considers whether the price closed higher or lower, ADL takes into account the closing position relative to the high-low range of the day. If the price is going up but the accumulation distribution line is falling, it might mean that the buying pressure is weak and that the price increase could be unsustainable. Conversely, if the price is declining but ADL is rising, it could mean that selling pressure is weak and a reversal might be on the way. Another advanced tool worth mentioning is the ** check-in money flow CMF **. This indicator also uses price and volume to determine whether a stock is being accumulated or distributed over a specific period. CMF looks at both the volume flow and the price position within the range to determine if buying or selling pressure is dominant. A positive CMF value indicates buying pressure, while a negative value points to selling pressure. It can help traders spot shifts in market sentiment before they are reflected in the price. The ** Klinger volume oscillator * is another advanced volume indicator that can help spot long-term money flow trends. It calculates the difference between two exponential moving averages of volume and helps you determine whether money is flowing into or out of an asset. When the oscillator crosses above its signal line, it suggests that buying pressure is increasing, and when it falls below, it indicates that selling pressure is growing. This tool can be particularly effective in confirming the direction of the trend, especially in longer-term market analysis. Using these advanced indicators can provide you with deeper insights into market movements and help you determine the underlying strength or weakness of price actions. They can assist in confirming trends, spotting reversals, and providing a more nuanced understanding of how volume affects market behavior. When used in conjunction with traditional price chart analysis, they can significantly enhance your trading strategy. Let us get practical and talk about how to actually use volume in your trading strategies. One of the easiest ways is to use volume to confirm a trend. If you are in an uptrend and you see volume rising, that is usually a sign to stay in the trade. It means that buyers are still in control. You can also use volume during breakouts. If the price breaks out of a key level and there is a volume spike, it could be a good time to enter the trade in the direction of the breakout. Another way to use volume is during reversals. If you see volume spiking at a key resistance or support level, it might mean that the price is getting ready to turn, and it could be a good time to enter a trade in the opposite direction. Now let us talk about risk management. Volume can be helpful for setting stop-loss levels. You can place your stop-loss just below a key volume level, like a recent high-volume spike. This way, if the price suddenly moves against you, you have a clear point to exit the trade. You can also use volume to decide how big your position should be. When volume is high and it confirms your trade, you might decide to increase your position size because the move is more reliable. But if volume is low, you might want to trade smaller, since low volume can lead to unexpected and choppy price movements. As you start using volume in your trading, there are a few common mistakes that you should be aware of. One big mistake is ignoring volume during breakouts. Entering a trade without checking if volume supports the price movement is risky. You need volume to confirm that other traders are behind the move, as a breakout without volume can often lead to a false signal. Without sufficient volume, the breakout might lack the necessary momentum to continue, resulting in the price falling back into the previous range. Another mistake is overreacting to small volume spikes. Not every little spike means something significant, especially if it occurs without any key price action. Volume spikes are only useful when they coincide with important levels, such as resistance, support, or trend lines. Always look for confirmation from the price before making a decision based on volume. For example, if there is a sudden volume spike, but the price does not break a key level or show any directional momentum, it may not be a reliable signal. Another common error is misunderstanding volume divergence. Volume divergence occurs when price and volume do not align. Traders often mistakenly overlook the importance of volume divergence, which can signal a weakening trend. For instance, if price is making higher highs but volume is decreasing, it indicates that fewer participants are buying at these higher prices. This divergence can often predict a reversal or consolidation phase. Lastly, do not rely only on volume. While it is a powerful tool, it works best when used along with other indicators like moving averages, trend lines, RSI Relative Strength Index, or MACD Moving Average Convergence Divergence. Combining volume with other tools will give you a better picture of what is happening in the market, increasing the probability of making the right trading decision. For example, volume paired with RSI can help spot overbought or oversold conditions, whereas combining volume with trend lines can help confirm breakouts or breakdowns. To wrap things up, the volume indicator is all about showing the level of trading activity at any given moment. It helps you confirm trends, spot breakouts, and identify possible reversals. Remember, volume is about the commitment of traders. When volume backs up a price move, it is stronger. Use volume to get a better understanding of whether a trend is likely to continue or if it is losing strength. The more you practice with volume analysis, the better you will get at spotting opportunities and avoiding risks. I hope you found this explanation useful. Take some time to start practicing volume analysis on your own charts. Look for those moments when volume is confirming a move or showing a potential reversal. Keep working at it and you will become more confident in using volume to make better trading decisions. If you have questions or thoughts, share them and keep the learning going. Keep at it, and you will be on your way to becoming a more informed trader.